Welcome to Crypto 101, a first principles jargon-free course on blockchain and its impact on financial services. In the previous lesson, we learned about the four categories of crypto tokens. In this lesson, we will take a brief detour from crypto tokens for an understanding of ERC-20 standards. We will then resume our discussion of crypto tokens with a discussion of ownership tokens. In the previous lesson, we encountered the term ERC-20 tokens. In this lesson, we will understand what that means. Before we explain what ERC-20 means, let us recap something we learned in the previous lesson. We categorized crypto tokens into native tokens and smart contract generated tokens. Native tokens are generated and recorded at the blockchain protocol level. Bitcoin and Ether are examples. Smart contract tokens are generated from a software code contained within the smart contract address and recorded at the contract level only. For example, Ethereum has no knowledge of what Tether is. The meaning of Tether is contained within the smart contract itself. ERC-20 refers to a voluntary standard by which fungible tokens are generated via a smart contract software program on Ethereum. Fungible token refers to tokens where each token is indistinguishable from the other. Tether tokens on Ethereum are fungible and are an example of ERC-20. What do we mean by standard? Next, we will explore what this means. Consider someone who simply writes on a piece of paper how much to pay someone. This is non-standard. Now, consider a check. The check has specific fields where you put in information. All checks, at least within the boundaries of a country, follow a certain layout. On the top is the name of the beneficiary and on top right is the date. Then the amount in numbers is written along with the amount in words. Finally, at the bottom there is a signature panel. This is an example of a standard, which makes it easy for banks to process checks regardless of which entity the check writer banks with. ERC-20, similarly, is a standard that governs the creation of fungible tokens from an Ethereum smart contract. Our goal here is not to become software programmers well versed in the requirements of ERC-20. We are only developing a conceptual understanding of it. In that spirit, I will share a couple of illustrative examples of ERC standards. One standard is that the smart contract should return the total token balance owned by an Ethereum address, if the address is input as a query parameter. Another standard is the existence of a transfer function in the software code that allows the smart contract to record the transfer of ownership of a token between Ethereum addresses. ERC-20 is not mandatory. A software developer can choose to mint tokens via a smart contract that does not adhere to ERC-20 standards. The benefit of adhering to the standard is that it becomes easier for other applications to interact with the token-generating smart contract. For example, a wallet software that displays visually the token balances of a customer can pull data on token balances in the exact same way across different token contracts. This, in turn, makes it easier for the token to be bought and sold on an exchange. Now that we know what ERC-20 means, you may be curious why it is called so. ERC stands for Ethereum Request for Comments and refers to the technical document that describes standards by which a specific function of smart contracts should operate. Each such ERC is numbered and covers a particular aspect. For instance, ERC-20 covers fungible tokens, ERC-721 applies to non-fungible tokens. Anyone can propose an ERC, but it is up to them to encourage adoption in the Ethereum developer community. The ERC-20 was proposed in 2015. The associated code was published on GitHub. Developers could easily copy and paste the code. This resulted in large number of token issuances. We can now distinguish three taxonomies by which crypto tokens can be classified. First, they can be classified by design objectives. Cryptocurrencies, asset-backed tokens, ownership tokens and utility tokens. Next, we can categorize them by how they are generated. They can be native tokens or smart contract generated tokens. Finally, smart contract generated tokens can be categorized by the type of standard they follow. ERC-20, ERC-721 and ERC-1155 are examples. Note that standards need not be specific to Ethereum. Other programmable blockchains can have their own standards. Let us go back to our thread on the crypto token purpose categories. So far, we have covered cryptocurrencies and asset-backed tokens. In this lesson, we will cover ownership tokens. Ownership tokens represent proof of ownership of an asset. The underlying asset could be intangible or tangible. Examples of token conferring ownership of an intangible asset is an equity token that confers ownership rights on the earnings of the company issuing the token. An NFT confers ownership rights on an intangible digital asset like a painting. In theory, a token can also represent full or partial ownership of a physical asset like real estate. It is helpful to remind ourselves of a learning from a previous lesson. Ownership tokens are similar to asset-backed tokens in that their economic value is derived from the value of the underlying asset. However, the token holder, in this case, has an ownership interest in the asset. For instance, a token that entitles the holder of the token to rent earned on a real estate property is an asset-backed token. But the token holder does not actually own the real estate property. An ownership token would mean that the token holder actually owns title to property. The rest of the discussion on ownership tokens is structured around 3 examples. Equity tokens that represent ownership of a company. Non-fungible tokens that represent ownership of a digital asset. Tokens that represent ownership of a physical asset. Next, we will deep dive into equity tokens. Blockchain enterprises often raise money by issuing tokens. The tokens may be issued to the general public in a crowdsale or via private issuance to a business like a venture capital firm. The tokens issued may be any of the 4 types of tokens that we discussed earlier. The raising of funds to finance a project seems similar to initial public offerings, but the tokens issued, in most cases, are not equity because the token holders are not shareholders in the company issuing the token. Next, we will review an example of a token that was not an equity issuance, namely the Ethereum crowdsale. We will also review an example of a token that is an equity token. The example we will review is the T0 token. In 2014, Ethereum launched a 14-day crowdsale of Ether. Users could go to a website and buy as much Ether as they wanted. There was no limit on the quantity of Ether issued, but the price was set so that 1 Bitcoin bought 2,000 Ether. The buyers transferred Bitcoin from their wallet to a Bitcoin address owned by Ethereum. In exchange, the buyers received an Ethereum address that was eventually funded with pre-mined Ether when the Ethereum platform launched. The Ethereum Genesis crowdsale was not an equity offering. Ethereum is registered as a non-profit foundation in Switzerland, and the tokens represent donations to the foundation by token holders. Ether is a cryptocurrency and does not carry any ownership rights on the earnings of the Ethereum Foundation. The Ethereum Genesis crowdsale demonstrates what is commonly known as the 3 Ws of token issuance. A white paper that describes the purpose of the token. A website where users can log in and place orders to buy tokens using fiat or cryptocurrency. Finally, a wallet address, which is issued to the token buyer and will be recorded as the owner of the newly minted tokens. Note that the term wallet address is somewhat misleading. What it really means is that the private key to the blockchain address is held in the wallet. Issuance of equity tokens grant explicit equity ownership rights on the enterprise that issues the token. Next, we will review an example. In August 2018, the e-commerce company Overstock.com launched a coin offering to finance the creation of a blockchain platform that would enable companies to raise funds by issuing tokens that were compliant with U.S. securities law. The coin was called T0. The name of the coin refers to the goal of the platform to settle equities on the date of the trade, hence day 0. For those who are not familiar with capital markets operations, the name T0 will not make much sense. But this does not impact what we are about to learn. The key takeaway here is that even though T0 token was issued via an ERC-compliant smart contract on Ethereum, it followed all regulations applicable to equities. The T0 token was equivalent to preferred shares. Shares of a company can be issued to the general public via an IPO. Alternatively, shares could be issued only to accredited investors via a private placement. The T0 token issuance was structured as a private placement. Only select investors were invited. We can now go to Etherscan and pull up the T0 token details. We can see that there are 243 token holders, with the largest token holder owning 60% of the tokens. Once again, I pull up the T0 smart contract. On the top right, I can see the contract creation transaction. Next, I will click into this transaction. The address from which the transaction was initiated represents an Ethereum address owned by the company issuing the token. We will refer to this as the issuer address. The to address is the smart contract address itself. In reality, the transaction is directed to a null address, which creates the new address that you see here. You can see the gas price that was paid to deploy this contract. I will go to the transaction tab of the smart contract and go the very beginning. Let us give a few moments for the transactions to load. Now that the transactions have loaded, I click on the last tab, so that I can see the Genesis transactions. Next, I click on the issue token transaction. We can see that this transaction transfers the ownership of the smart contract tokens to the issuer address. The from address is null. This indicates this is the Genesis transaction that mints the new tokens within the smart contract. At this point, the tokens are owned by the issuer address. Now let us go back to the transaction tab. We can see multiple transfer transactions. Next, we will open one of them. On opening one of the transfer transactions, we can see that the transaction transfers ownership of tokens from the issuer address to the Ethereum address of the initial coin offering subscriber. This concludes our discussion on equity tokens. We are yet to discuss the other two examples, relating to ownership digital assets and physical assets. We will cover these in the next lesson. For now, please review the summary of this lesson. I will see you shortly on the other side.